Welcome back, everyone, to day 2 of the Modern Investor Summit. I'm Michael Sidgmore, co-founder and partner of Broadhaven Ventures and founder of the Alt Goes Mainstream podcast. Today, I'm thrilled to be joined by a very special guest, Lawrence Calcano, chairman and CEO of iCapital. Lawrence brings a wealth of experience in the world of alternative investments. Under his leadership, iCapital has played a pivotal role in democratizing access to private markets, making them much more accessible to a broader range of investors. And now the platform has over $200 billion of assets. His insights will be invaluable as we explore how the retail investment landscape's evolving and why alternatives are quickly becoming a vital part of modern portfolios. We're excited to dive into our session, Alt Goes Mainstream, the retail investor's new frontier. So, Lawrence, thanks for being here.
It's great to be here. Thanks, Michael.
All right, let's dive in. I think you provide such a fascinating lens into the evolution of alternative investments through the context of the wealth channel broadly. So I want to go back to go forward to kind of put things in context for people. So we are where we are today, roughly 14, 15 trillion of assets in private markets. But the wealth channel is still very underallocated relative to institutional investors, a few percentage points max, relative to the Harvard endowment, et cetera. That would be 20, 30, 40% allocated alts. What was private markets like for the wealth channel investor 10 years ago when you started iCapital?
Well, it was obviously quite different and quite new. And I think, honestly, there was a lot of uncertainty about how this was all going to work. Most of the GPs, and I don't think this is an exaggeration, weren't at all focused on this wealth channel. They had historically always raised money from institutions, and that was working out really well. They were raising a lot of money from institutions. And for the best managers, all their funds were oversubscribed, et cetera. So they weren't really that focused here. I'd say family offices were sort of their biggest non-institutional constituency. And then they also had some relationships, in some cases, with some of the big bank platforms that provided access to their wealthier clients, all of which was done in these private funds contexts. The wealth channel itself was interested and intrigued with getting access to these investments, and in some cases were actively trying to find these investments, but in many cases were not. And I would say I always like to think of these markets in the context of sort of adoption cycles. And in the early days of this market, the first wave of early adopter advisors were willing to put up with a lot of headaches in making these products available to their clients. Subdocs were usually not completed. They would get subdocs back from clients and there would be lots of blanks. In many cases, they would get subdocs back and there were no signatures. I know in speaking with advisors, some advisors would get in their car and drive to their client's house to get rows filled in or documents signed. It was very hard. There was no automation. It was all manual. And so it was a difficult process. But I think over time, and I know we'll go forward, that's changed dramatically with the changing access, changing technology, and so forth. But in the early days, go back 10 years ago, it was quite challenging for clients to get access to alts.
So basically what you're saying is it's not like public markets investing experience. And we've obviously had this rise of retail brokerages, the Robinhoods, the Revoluts, et cetera, of the world where people can just click and trade. Private markets, you can't do that, right? So we're going to get into that on the technology side and how infrastructure has played such an important role in this. But before we do, I want to ask one question just to kind of help people really make sense of all of this. So you say 10 years ago, 2013, 2014, the big private equity firms, alternative asset managers, the Blackstones, Apollos, et cetera, not many of these firms were really working with the wealth channel broadly. What changed and why did it make sense for them to do that? And why did it make sense for the investors in the wealth channel to invest in private markets?
Sure. Well, to be clear, a few of them were focused on the channel. Some of the largest firms had developing and positive relationships with, again, generally the bank platforms, where they would bring their products, a feeder would be built, and then the underlying wealth clients would allocate to those feeders so that you would aggregate. And by the way, that was a really important component to this because the asset managers' infrastructures were all built to take institutional subscriptions. And specifically, that would mean a small number of investors making very large commitments. And the middle and back offices of the asset managers were built to handle that. As you come into the wealth channel, it totally flips, where you get a very large number of smaller tickets. And so these feeders or aggregation vehicles allowed them to effectively get one ticket that might have had 100 or multiple hundreds investors in that, but they could treat it like one institutional ticket, right? So there was definitely some, beginning activity and exciting activity. And as I said, some of the more sophisticated advisors were very excited to go and access these types of investments for their clients. And as we've come forward, I would say that the interest, as people understand more about how these assets can really help client portfolios, that interest has grown dramatically. And that's required the industry to break down many of the impediments that prevented large-scale access in the first place.
So we're going to fast forward from 10 years, like few trillion of AUM, roughly speaking, to now like close to 15 trillion of AUM in private markets. We're going to go from iCapital in 2013 had $0 of AUM, now has over 200 billion of platform assets. Just kind of level set for people, like how much this space has grown and how fast it's grown. What is happening in private markets right now in terms of the wealth channel getting access? Like, is it mainstream?
So I don't think we're mainstream yet. You mentioned this in your introduction. There's probably roughly a 2 to 5% allocation to alts. There's lots of zeros, by the way, but 2 to 5% on average. If you look at what the target allocation is at some of the largest wealth managers, their targets are 15 to 25%. So nowhere near the sort of the suggested target allocations by the CIOs. And the other thing I would say, just to kind of level set where we are, I would say today probably 20% of the advisor population probably drives 75+% of the actual volume, which means that there's 80% of the advisor population that is really not yet fully engaged with this asset class for their clients. That's changing dramatically, and 10 years ago that might have been an even more concentrated number. So it's definitely changing. More advisors are really digging into the asset class on behalf of their clients.
And we're just at the start of the brokerage firms. Like Schwab has announced that they're getting into alts in a big way. Fidelity, same thing. That we're just at the start of this for
we are
the broad wealth channel that access private markets.
But we're seeing it really start to accelerate, right? Certainly all the wirehouses have been providing access for years, as I mentioned. Many of the IBDs have been, or certainly have been, increasing their sort of access to alts that they provide for their advisors. The RIA channel, which is massive, is really widely adopting alternatives. So we're really seeing the industry, the wealth management industry, understanding and adopting these assets because of how they can help client portfolios. And at the same time, that's mapping to a realization on the asset management side that you take, I think BCG put out a statistic last year that said there's roughly $145 trillion owned by high net worth or retail investors globally. That's a massive pie, and frankly, roughly equivalent to the amount of money controlled by institutions. So it's a very significant amount of money that has a real interest in allocating these assets. So there's a real sort of mapping of the minds, if you will, between asset managers who now recognize the size of the channel and the channel itself recognizing how these assets can help outcomes.
You share that, roughly it's the 80-20 rule. So 80% of the advisors haven't really adopted alts in a big way. There's, like you say, out of this 145 trillion of assets in the wealth channel, only a small percentage of that is actually invested into private markets. What does it take to get to the next phase where they do adopt 10, 15, 20% allocations to private markets?
So I think the most important thing is education. When you think about even advisors who are in the business, continuing to understand, the more you invest in the business and the more change, there's a lot of dynamism in this industry, new structures, new approaches. You're on a continuing process of learning about and thinking about and evolving. So advisors doing the business continue to evolve. And as we've been talking about, there's a very large number of advisors who haven't yet really embraced the asset class in a meaningful way. And so making sure that those advisors and their clients are well educated, to me, is sort of job one for everybody in the industry. And I would say that, and you think about, okay, you've got all this excitement today about alternatives on both sides, as we've been discussing. What's the thing that could kill that enthusiasm and momentum? It's bad outcomes, right? And I think the industry is very connected, or should be very connected, in a common goal of making sure that the underlying investors have good outcomes. And that means that the investments behave the way you expect. Not every just like stocks and bonds, not every investment is going to be a home run, right? Or work out the way you think. But you need to understand, how is the investment supposed to work? How does it fit into your portfolio? If people have the right set of expectations and they have good investment outcomes, that's going to encourage them to continue to allocate to these assets. And therefore, the whole industry, the advisor, the wealth management population, certainly the GP population, has got to invest the time in educating advisors and clients on what to expect and how this asset class can help them achieve their portfolio objectives.
I think that's so important to touch on, because understanding the mechanics of private markets, where they fit into a portfolio, is so important. I want to unpack that and take kind of a different dimension of this, which is, as you were sharing your thoughts, the concept of patience came into my mind. And if you think about the world we live in now from an investing perspective, geopolitics has changed things. Rates have changed. That's made public markets more volatile. There's obviously in public markets been this move to indexation, rise of passive. Mag 7 has concentrated a lot of returns, yet more companies are private than ever. And how should investors, particularly younger investors who've now grown up in this very volatile investing world where cycles may happen a little faster, how should they think about investing maybe in a more patient way? And how does private markets fit into that?
So there's a massive amount in your question. I'll try to hit on a couple of points. And I'm going to first start with patience. One of the things to keep in mind with this asset class is that it is illiquid for the most part. Even some of the newer structures which have liquidity features is, generally speaking, illiquid. And that illiquidity is not a bug, it's a feature, okay? And what I mean by that is, let's talk about private equity, but the same is generally true about private market investing as well. It's sort of the ultimate active asset class. So when I buy a stock, a common stock, IBM or some other company, even if I'm a large investor, I'm buying it, I'm following them. I've developed a point of view on the company, and I'm watching. Maybe I go to an annual meeting if I'm a big investor and I can ask questions and so forth. But that's sort of my impact, right? In the private context, when a private equity firm invests in a private company, they are actively involved in influencing and helping to determine the outcome of that. Maybe they change the management team. Maybe they sell off parts of the business or buy other parts of the business. But what they do during the 3 to 7 years that they hold that company is really critical to determining the success of that investment. Have they grown revenue? Have they expanded margins? These are the kinds of things that generate real alpha in investment returns, right? And as we think about what are the sources of return to these assets, there's really kind of 3 big buckets, one of which is financial leverage, right? And that's a commodity for the most part. 2 is there some multiple arbitrage? You bought at one multiple, you sold it at a higher multiple. And 3 is this value creation process I'm talking about. That is by far the most important determinative of alpha. And what we look for in the private equity managers that we are sort of suggesting to clients might outperform. So it's that focus. And so that process takes time. So when you invest in a private equity fund or a private company, you have to be prepared to let that process play out to be able to be successful in terms of the investment outcome.
I think that brings up a really interesting question, which is, one, how are investors in the wealth channel accessing private markets? Are they doing it through funds? Are they doing it through direct deals? Yep. Then I think that brings up the next question of how should they access investments in private markets?
The answer to that is not dissimilar from asking the question, should you buy a common stock or should you buy a mutual fund, right? Or an ETF? And I think part of it has to start with how much education and capability and experience do you have in making those types of analyses and judgments? And the second piece is how much time do you have to do it? If you have a full-time job, it may be that you do or don't have enough time to actually do the hard work, right? And so I think in the private markets, where it's just a little bit harder to get the information, it's a little bit harder as an individual to find the right set of opportunities, that investing through a fund where you have professional management who are making, A, who have a very wide funnel of choices, B, have lots of resources at their ability to do that due diligence to make the decision on the investment, and C, have the ability to provide that active management I talked about before that you may, as an individual, not quite have, right? And so I think for a lot of folks, not for everybody, for a lot of folks, investing in great managers and great funds might be a better way, certainly to start, if not over time. And perhaps you invest largely in funds and you can complement that by investing directly in some private companies. But again, private companies are illiquid. And the other point worth making here is, and I've seen this a lot of times, where you can imagine the beginning of a life when the equity is worth very little, and there's some end of the life where, let's say, the equity is worth $1 billion. It's a unicorn, big success. What isn't always true is that means that every investor has had a great outcome, right? Because a lot of times in the lives of these companies, they follow a bit of a roller coaster. Maybe they go straight up and to the right. That's great. But sometimes they go through processes where maybe the business didn't grow quite as fast, so they had to do another financing. Maybe that financing had terms and conditions that were negative for prior investors, and you might get to the high point on the right, but there may be periods of time where prior investors actually had their positions degraded for whatever sort of reason. And so that's another reason why it's sometimes better to invest with fund managers who can manage that process more effectively.
That's not too dissimilar from public markets, right? Sometimes being more actively managed, particularly, some institutions, some individuals do perfectly fine, but a lot of times if you time things wrong, then you're not going to end up with good returns.
Amazon came public. Everyone was so excited about Amazon. It's obviously an incredibly important systemic company, but it traded down after its IPO. This is in the public context. Obviously, you have the ability to buy and sell immediately with public companies, which you don't have in the private markets. But there's a lot of examples of great companies that had some very difficult periods in their trading history that don't reflect where they are today.
It's a really important point because I think that illustrates, in some senses, the power of private markets. If you had a 20-year time horizon on Amazon and you just bought and you didn't think about what would happen in the middle, you might end up having a fantastic return. Obviously, entry point matters, but that's somewhat similar conceptually to private markets, where depending on obviously the company you invest in or the fund you invest in, if they do a good job helping that company grow, that matters, right?
It matters a lot. And I think that in the context of a fund, you're watching a whole portfolio of companies play out over time, right? And I think for a lot of people, they could probably tolerate a little more illiquidity than they think. In terms of what do of their assets, what do they specifically need within what time windows? In a lot of cases, there's some amount of your portfolio that you benefit by keeping that in less liquid investments, and you can watch them compound, to your point, over long periods of time. And I think one of the questions you had earlier is when you actually think about, or the comments you made, when you think about the number of public companies, that's been shrinking a lot, right? You have M&A, you have Eureka, you have lots of reasons why there aren't as many companies, and many private companies are just staying private for a lot longer. And so I don't know exactly what the multiple of private to public, but there's a larger number of private companies as compared to public companies. And so if you're not somehow accessing that private market, you're limiting your investment horizon or menu quite significantly.
Yeah, I think that's just such an important point. I think that the number is like 87% of companies in the U.S. with $100 million or revenue or greater are in private markets. So if you don't have access to that, you're missing out on a massive sea of companies to get exposed to, which I think it's a really important point. I want to touch on how you think about this evolution in private markets. How and why do you think that now is the time for the wealth channel to get access?
Well, look, I'm going to answer your question, but it may not be for everybody. And I think it's really an important point to make, which is we think that there are real benefits to private investing and diversification, potential for enhanced returns, et cetera. But the assets may not be for everybody, and I think that's just an important point for people to keep in mind. But as you think about why has this evolved, why is it changing, I think a big part of it is technology. I talked in the beginning of our discussion about the poor advisor that has to drive to someone's house to get them to finish. So much of what was manual for a long time is now being automated. And so now I can see funds, I can look at a menu of funds like a platform like on iCapital, where you can see lots of choices. You can see diligence and information on those. The process of subscribing to those funds is automated. I can do it electronically. The process of getting reports, of seeing my investment, not just a given investment, but a whole portfolio of investments online, how they're doing on an investment dashboard. So the automation is helping to make this whole asset class a lot easier for advisors to bring to their clients. And as we go forward, the technology continues to evolve, which actually allow advisors to customize the types of exposures they create for their clients. And so maybe you want to buy a fund that has 4 or 5 managers in it. There's technology to process that we've introduced. Maybe you want to buy a model portfolio. A lot of people buy models in the public markets. We're now introducing models, and the industry is introducing models. So there's a lot of there's an evolving and increasing number of ways for people to access this asset class. And we're not where mutual funds are, where you hit a menu, click a button, and it's all done. But we're moving in that direction. And one of the things we've been trying to do is create an operating system for the industry to be able to allocate seamlessly to these assets. And that includes how you learn about them, how you invest in them, and then how you own them over long periods of time.
On that point about education, because you mentioned that this is so important, what are the ways that investors can become educated on private markets, even if it's not right for them today, but how can they start to get educated on it?
Well, I think they should start talking to their advisors about what can I learn, spend time with their advisors. There's a lot of classes in the industry. We put out an awful lot of material for both advisors and clients to understand these assets. So talking to their advisors, reading stuff online from iCapital or others. Almost all of the large private equity firms have invested significantly in their universities or other programs, and they've got some great stuff on the asset class, specific strategies, and so forth. So I think there's a lot of information out there that probably wasn't available, 5-10 years ago.
I think that's a great segue to some misconceptions with some definitions around private markets. I think words really matter and definitions are important, and how people think about things are important. So on that point, I'm going to throw out a few different words, and we're going to discuss like what are some of those misconceptions. So one is liquidity. How important is it? Because a lot of times people are concerned about private markets because it may be a more illiquid asset class, and then they can't get their money when they, in theory, need it. What is your view on liquidity?
Well, they shouldn't invest in private equity or private markets if they need their money back soon, right? And so I think one of the most important things that an individual investor should be doing with their advisor is actually like understanding and planning, when do I need capital? Do I have big life events? Am I buying a house? Am I, or children getting married? Whatever your big sort of capital consuming events are, you should understand that. And when you buy or invest in private markets, you should do that with assets that you are not going to need to call on for the life of that investment. Now, some of the newer products in private markets have certain liquidity features of some of the evergreen or registered funds. But I think it's really important for people to keep in mind is while those products might have some liquidity features, that doesn't mean they're liquid in the same way that people think about stocks and bonds, right? And so there's still restrictions. They just happen to be on a relative basis more liquid than some of the private funds. But I think it's a really individual by individual determination that has to get made in terms of when do you actually need liquidity. As I said, I do think some people need liquidity not necessarily for an event, but for psychological reasons, and that matters. I do think to some extent people might overvalue that relative to investment opportunities, but that's a personal decision that everybody has to make for themselves.
So speaking of personal decisions, I think the next concept I'm going to throw out, it relates to that, which is I'm going to borrow from Apollo CEO Mark Rowan, who said the conception in markets was once that public is safe and private is risky. That may not necessarily be the case anymore.
Yeah.
What are your thoughts on that?
He's right. He's of course exactly right. I mean, have you ever lost money in the stock market?
Yes.
Have you ever lost money in the bond market? There is risk with all investing, right? And I would argue that for some people, the private markets, you sort of make an investment and it compounds, and you're not sort of in this mode of, I gotta sell it, it's going down. Like there's a psychological roller coaster that sometimes it's really odd. Sometimes people are like, when the stocks go up, all they want to do is buy. And when stocks go down, all they want to do is sell. And those may be the right decisions. Those also may be the wrong decisions, right? And so I think there are risks in all investing. And I think there are certainly risks in the private markets. But people have to understand what those are. And I think a lot of the risks are around this liquidity, which is a different kind of risk. It's more of it's almost as much of a fit issue as a risk issue. But I think that's one of the big areas where people really need to get educated.
So another possible misconception about private markets is that private markets is private equity. Is that the case?
No, I mean, private markets really incorporates all the different types of strategies. There's private equity, private credit, private real estate, private infrastructure. We, in our platform, are very focused on making sure people have access to all of the different types of private market strategies so they can build a thoughtful portfolio across all the different strategies. And we see at certain moments in time, there's a very significant interest in private equity. Other moments in time, there's a much more significant interest in private credit. And people, there's a shift in what might be the best thing to invest in at a given point in time. And people have to have access to all those strategies.
I think kind of tying together a bunch of the things that we just discussed, and you've said this in the past, that equity is maybe just going to be, there's going to be public equity and there's going to be private equity. Credit, there's going to be public credit and there's private credit in a portfolio. It's no longer a 60-40. Yep. What do you mean by that? I want you to unpack that a little bit.
So right now, people say, there's this asset class called alternatives, right? It's a separate thing. But as we just discussed, some alternatives or some private markets investments are equity oriented, some are credit oriented, some are real estate oriented. And I think over time, as these assets get incorporated into a portfolio more completely, they may not be at 25% of the CIO, as I referenced earlier, but it could be that they're 10 or 15%. I think people are going to think about their asset classes as being more holistic. So I'm going to have an allocation to equity. My equity allocation will include common stock, some ETFs, maybe some private companies, and maybe a venture fund or a private equity fund, et cetera. My credit allocation will have some corporates, some treasuries, some unis, maybe some private credit, maybe some opportunistic credit. It'll have different types of strategies in it. And the same with real estate and so forth. And I think that's how this will evolve, where the portfolio will have some components that are more liquid than others. And together, it'll hopefully produce returns that fit with an individual client's needs for liquidity, as well as returns and long-term appreciation.
What's so interesting about what you just said, and where my mind goes in that context, particularly for the wealth channel broadly, is many people are used to saying, okay, I own Amazon, or I own Facebook stock,
yes,
or some stock they own, they think about that. Well, can't they just do the same in private markets? And if private companies are staying private longer, whether they own it directly through a co-investment or through a private equity firm, they can say, hey, I own XYZ company that's in private markets, just like I own some exposure to Facebook or Amazon.
It's happening today. When you look at all the different types of wealth managers in the industry, the wirehouses or IBDs or RIAs, many of those platforms are very focused on offering their clients access to individual names for people to have chance to invest in those. Again, that's not going to be for everybody, but for certain investors, that could be an excellent way for them to invest. And it's certainly of significant interest by the wealth management platforms and for a number of their clients to get that kind of access.
So I think you bring up an interesting point, which is this kind of almost merging of public and private. These two parts of the market are coming together. Technology is underpinning that, enabling that to happen, because technology market infrastructure in private markets is starting to evolve in the same way that public markets infrastructure has over the last 40, 50 years. What does private markets look like in the next 5 years?
Well, look, I think the allocations are going to go up. We talked about the participation rate earlier, right? We talked about how a small number of advisors are currently participating in more or not. We also effectively talked about the allocation rate, right? Talked about CIO targets at 15 to 25%, actual allocations at maybe 2 to 5%. So I think over the next 5 years, you're going to see an increase in both. You're going to see an increasing participation rate, and you're going to see an increasing allocation rate. And you're going to see people start to think about building these portfolios slightly differently. They won't be thinking about it, as we said, a separate alts allocation. They'll be thinking about incorporating alternatives into each of their strategic sleeves: equity, credit, real estate, et cetera. And I think that will come with incremental technology to make that easier. We've introduced the ability to build portfolios, to understand how alts impact your portfolio, what alternative investments make your portfolio more aligned with what your goals are, less aligned, et cetera. So there'll be more tools to help people build that incorporated portfolio. But it's going to take time. And you mentioned the word patience earlier, and I think everyone, all of us, has to be patient, because there's the education cycle and the adoption cycle that just will play out over time. And that's a healthy thing.
That's also great advice for investors. Patience,
yes,
key, and private markets is really about patience and thinking for the longer term. So it's a great conversation. I think covered so much interesting aspects of where private markets were, or alternatives were. Now it's private markets, and where it is today. Thanks, Lawrence, for sitting down with me, sharing all these thoughts with the Finimize audience.
That was my pleasure. Thanks for having me.
Awesome.